Hedge funds have been taking on massive losses and massive withdrawals, and this will lead to giant liquidations. Today I also want to talk about potentially the first bank that will end up going bankrupt and will end up collapsing. So stay tuned and let's make some money. And I want to dive straight in with the key information. So, this article from Reuters says that hedge funds' assets have shrunk amid investor withdrawals and losses. So it says hedge fund assets fell below $4 trillion in June, and that was dragged down by poor performance and investor withdrawals. So between April and June, investors redeemed $27.5 billion from hedge funds, bringing the total withdrawals for the first half of the year to $77 billion. And importantly, no hedge fund lured fresh money from investors in the second quarter. Obviously, as more and more investors withdraw from these hedge funds and more hedge funds take on heavy losses, again, it just pushes the hedge fund industry as a whole closer and closer to that liquidation point. When investors withdraw money, hedge funds have to sell off stocks, and when hedge funds sell off stocks and take on heavy losses, they get closer and closer to this liquidation point. If investors aren't putting in additional cash, which they're not, they don't get further away from that liquidation point, they get closer and closer. And when a hedge fund goes bankrupt and ends up being liquidated, they're forced to sell off all of their assets and all of their stocks, and again this pushes the price of stocks down further, causing more losses across the spectrum. And especially for those over-leveraged funds that are getting closer and closer to that margin call position, it puts them in an ever stickier and stickier situation. And one bank that I think is in a very sticky situation indeed is Bank OZK. Danielle tweeted saying this tweet is not recommended but required reading. So it says, unlike bigger banks, OZK doesn't usually ask borrowers to pledge their personal wealth as collateral, aka doesn't require collateral on loans, and it doesn't sell off parts of their loan to others, and it helps Bank OZK win business. But it also means that OZK has more exposure in the event of a default. And in terms of construction and land development loans, Bank OZK is providing more loans than Wells Fargo, Bank of America, Citibank, JP Morgan at an absolute magnitude. Wells Fargo provided only 2.3% of recent construction and land development loans, but Bank OZK provided 42.2%. Because Bank OZK doesn't require any collateral, all of these firms and construction companies are jumping at the opportunity to borrow money from Bank OZK. But the problem being is that if that construction company or that land development company defaults on the loan, Bank OZK are completely out of luck and they can't recover a single penny. So this tweet is in reference to this article that says the most prolific lender to Manhattan property developers isn't Wells Fargo or Citigroup or any of the other big global banks. They said it's Bank OZK, which not long ago was an obscure lender from Little Rock, Arkansas. And the bank has become one of the country's most aggressive financiers of skyscraper construction. And the lender is one of a group of regional banks and debt funds that are propelling the recent surge in commercial real estate development. OZK has $7.7 billion in construction and land development loans, and they hold more construction debt than Citibank, which is about 65 times as large. But obviously the problem being is that when commercial real estate construction starts slowing down, maybe if the Fed raise interest rates like they're doing right now, then Bank OZK is going to be completely out of luck and they may lose everything. I think this bank is going to start taking on more and more losses as the real estate market starts to crash until they end up defaulting, going bankrupt and collapsing. And this could actually end up happening very, very soon. As Wall Street Silver tweeted, he said, first, the globalists print the money to create inflation and the property bubble. He said next, they raise interest rates to collapse the real estate market, and then they scoop up real estate at bargain prices. Obviously, the Fed has been increasing interest rates, and this is having a damaging effect on the property market already, or on the real estate market already, as many people across pretty much all states are having to drop their asking prices. Because interest rates have increased so much, monthly mortgage expenditure has obviously gone through the roof. Therefore, people can't afford the properties they once could a few months ago or last year, and therefore sellers are having to drop their asking prices. But interestingly, this comes at a time when Blackstone draws over $24 billion in commitment for their latest real estate fund. And guys, if you haven't already, be sure to sign up to Moomoo right now using the link in the description below. You can currently get 10 free shares worth up to a total of $25,000 and a guaranteed free share of Lucid on top of that. Moomoo is also very easy to use. It's incredibly customizable. They've got tons of technical indicators and advanced charting tools. From Moomoo's latest customer agreement, they officially state they do not benefit from your order flow, and they do not sell your order flow to market makers like Citadel or to clearing houses like Apex Clearing. In fact, they clear their trades on their own through their own clearing broker, Futu Incorporated, which does also not accept payment for order flow. And therefore, Moomoo is brilliant for buying those AMC and GameStop shares. It seems the Fed may be purposely trying to crash the property market or crash the real estate market, so these large funds like Blackstone can swoop in and pick up these properties at a large discount. But in terms of AMC and GameStop, it seems like the squeeze is getting ever closer. GameStop had their stock split earlier this morning, and the cost to borrow rate for these GameStop shorts has quadrupled. The average cost to borrow for GameStop shares yesterday was 31.8%. This morning at market open, that increased massively to 124.3% average. Tendy Baron tweeted saying on IBKR or Interactive Brokers, on GameStop, their borrow rate increased to 124.33%. So Tendy Baron actually spoke to the live support team and asked if the borrow rate had indeed quadrupled overnight. He asked if it was a glitch or an incorrect error, and the live chat host actually double checked and confirmed the borrow rate or the borrow fee was indeed 124%. This obviously now makes it significantly more expensive to borrow those GameStop shares, on top of the $3 daily NSCC fee for every single share that fails to deliver every single day. With millions and millions in FTDs, that's millions and millions worth of fees these shorts pay on a daily basis. And in terms of GameStop specifically, this FTD fee has now just quadrupled, and also the cost to borrow these shares has quadrupled as well. And as a Morton GME picked up, the borrow rate should have actually been divided by 4, not multiplied by 4. Considering there's 4 times many shares, it should have made it cheaper to borrow these GameStop shares. But obviously, as all of these hedge funds and all of these trading platforms need to borrow hundreds of millions of GameStop shares to fulfill the split, instead the cost to borrow fee has actually quadrupled. This screenshot from Fox Business shows that 94% of retail investors are still holding their stocks or buying more. Only 6% of retail investors have actually sold their stocks. Therefore, this is again just more and more confirmation that these retail investors and these AMC and GameStop apes are still holding our shares and continuing to buy more. And as Kabesilet tweeted, he said the theme of widespread liquidation in this market continues to prevail. He said on days where stocks are red, everything is red, as if it's a run to the sidelines. And he said investors are beginning to realise that deflation is coming. He said once inflation peaks, it will be a bolt to the sidelines, and the last one to the door will end up being liquidated. Kabesilet still believes that inflation hasn't yet peaked, the Fed will have to continue raising rates, and inflation will continue to increase. And therefore it seems like the market will be stuck in this seemingly never-ending loop of taking 2 steps down, 1 step back up before taking another 2 steps down. And he said when inflation continues to rise significantly, investors will bolt to the sidelines and will be selling off their stocks as fast as they possibly can, causing a massive Hail Mary crash in the market. And obviously, as I've said before, I do believe this massive Hail Mary crash or this widespread liquidation will cause a number of large hedge funds and potentially some large major banks to default and to collapse. And obviously a massive Hail Mary crash in the market followed by tons of defaulting hedge funds and liquidated hedge funds will cause a further crash in the market and AMC to squeeze. As Stick to Stocks said, a forced liquidity crisis is what's coming for the shorts. When these shorts get closer and closer and closer to this margin call because they've used up all of their available liquidity, pumping and dumping any stocks they possibly can, they will end up in a liquidity crisis, being liquidated, forced to sell off all their long positions, and forced to buy back their shorted shares. And I believe this will cause the AMC and GameStop squeeze. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.